Strip out the asset sales and the buyback programs, and 3 of Singapore's most trusted blue chips yield less than Central Provident Fund. My job is simple. Even if the balance sheet is not, I read the numbers that the headline skips, the interest coverage, the gearing, the free cash flow sustainability, so that the Singaporean building or living off a dividend portfolio gets the same forensic clarity that institutional money takes for granted. This is one of those pieces where I had to run the data twice because I didn't believe it the first time. Turning first to what is actually happening behind the massive distributions on our local exchange. SingTel just paid out a record dividend, but its share price fell 3.7% over 5 days and 8.9% over 10 days. Meanwhile, the big 3 banks are returning 8.5 billion Singapore dollars to shareholders, yet 2 of them are sitting below their Zone 1 Common Equity Tier 1 threshold. When blue chips restructure, the numbers rarely tell the story the press release wants you to read. Where is your money actually moving? If you are chasing growth and momentum, a higher risk profile may work for you. But if you are a retiree focused on wealth preservation and dependable drawdown income, my forensic standard is built to protect that. It is not built to accommodate a momentum trade that could derail 20 to 30 years of compounding. I read the numbers the headline skips: interest coverage, gearing, free cash flow sustainability. The SGX restructuring narrative in 26 is relentlessly positive, but restructuring is simply a change in balance sheet arithmetic, not automatically good or bad. The critical question is whether the cash flows supporting your dividend are getting stronger or weaker. That distinction is what separates a safe income stream from a yield trap. What the market sees looks remarkably clean on the surface. SingTel's core dividend rose 14.3% year-on-year in the first half of financial year 26. Free cash flow rose 11% to 1.45 billion Singapore dollars, and net debt declined from 8.9 billion to 8.2 billion Singapore dollars. The headline numbers show a growing core payout and a declining net debt load. But what the forensic screen sees is a different reality. The load-bearing issue here is the VRD flag, which stands for Value Realization Dividend. This is a special payout funded not from telecom operations, but from the proceeds of selling off corporate assets. SingTel's full-year financial year 26 dividend consists of a core component of 13.4 cents per share and a VRD component of 5.1 cents per share. The second half VRD nearly doubled the first half, reflecting accelerated monetization of SingTel's Airtel stake. When the assets run out, the VRD disappears. SingTel's financial year 26 total dividend of 18.5 cents per share against a share price of $4.18 produces a yield of approximately 4.43%. That fails my 4.7% minimum yield hurdle, the income threshold required before any stock qualifies for a retirement portfolio. On top of that, operating company earnings before interest and taxes are guided at low to mid-single digits. The market was expecting 12%. Weak mobile average revenue per user and severe competitive pressures are not going away. The asset recycling program is real, the balance sheet is improving. Neither fact changes the yield arithmetic at the current price. The VRD is a distribution of capital, not recurring earnings. A retirement investor cannot rely on asset disposal proceeds as a sustainable income stream. We must evaluate a stock based on its ability to generate recurring cash from operations, not the liquidation of its core assets. Even if your CPF special account is already maxed out, the 4.7% hurdle still applies because it compensates for open market risks like gearing, distribution cuts, and permanent capital loss. The market does not offer a discount for running out of guaranteed options. Zone 4 is a timing signal, not a permanent rejection. It changes when the yield clears the hurdle, the balance sheet strengthens further, or the price corrects to where the maths works. A dividend backed by asset sales is a one-time event with a recurring label. When the assets run out, the yield resets. SingTel is paying a core dividend of 13.4 cents, but the extra 5.1 cents is funded by Airtel stake disposals, a finite resource. The forensic question is what core earnings can sustain when the recycling ends. Do not build your lifestyle around a liquidation distribution that cannot possibly be replicated indefinitely. If we look at the scenario analysis table, the financial year 26 actual yield stands at 4.43%, failing our hurdle. In financial year 27, if the VRD is completely exhausted, the core-only distribution of approximately 13.8 cents causes the yield to fall to 3.3%. That is a hard fail. Even if the VRD is sustained at a reduced rate of 2.5 cents, the yield only reaches 3.9%, still failing the 4.7% threshold. Moving on to the banking sector, DBS, OCBC, and UOB have announced capital return programs totaling approximately 8.5 billion Singapore dollars. DBS committed to a $3 billion buyback plus a 15-cent per share quarterly capital return through financial year 27. OCBC announced a $2.5 billion capital return framework, and UOB committed to $3 billion over 3 years via buybacks and special dividends. Let us look at what this means underneath the hood. The critical forensic question is whether these capital returns are drawing down the common equity Tier 1 buffer that protects your ordinary dividend. This ratio measures a bank's primary financial shield, how many losses it can absorb before your dividend is at risk. Our framework sets a Zone 1 fortress capital requirement at 16% or above, and a forensic floor at 14%. Any bank dropping below 14% enters the danger zone. For DBS, the situation is driven by capital accumulated well above targets, peaking at approximately 17% against the management target of 13 to 14%. They are returning this idle capital to optimize their return on equity. However, this specific capital return dividend runs through the end of 27 and then falls off completely. The balance sheet is strong, but retirement income models must be calibrated to the ordinary baseline, not the temporary headline. OCBC reports a common equity Tier 1 ratio of 17.0%, sitting comfortably above our 16% fortress threshold and clearing Zone 1 on capital strength. However, its ordinary yield of approximately 4.3% is still below our 4.7% hurdle. The final zone verdict remains on hold pending a full single stock audit, and its $800 million buyback balance remains unutilized. It may be distributed as a one-off special dividend by N26. UOB reports a common equity Tier 1 ratio of 15.3% as of the first quarter of 26, above the 14% floor, but below the 16% fortress line, Zone 2 for capital. Its ordinary yield stands at 4.06% based on a share price of $38.39, most conservative capital manager of the three. Protects stability, limits near-term yield upside. No further excess returns planned. When assessing banking yields, you must separate the three components: the ordinary dividend, the capital return, and the special dividend. Only the ordinary dividend is durable. Capital return programs boost effective yield temporarily, then disappear once the share buyback mandates close. Chasing the total yield figure without anchoring on the operational distribution is structural risk for a drawdown portfolio. 8.5 billion Singapore dollars in capital returns sounds like immense corporate generosity. It is balance sheet optimization. When buybacks and capital return components wind down over the next 24 months, your portfolio yield resets to the ordinary operational distribution. Check that number first. Build your retirement income models around what stays, not the temporary headline that is mathematically guaranteed to expire. Reviewing the yield decomposition table, DBS offers an ordinary yield of approximately 3.5%, with its capital return dropping off after financial year 27, placing it on our Zone 2 watchlist. OCBC provides a durable yield of approximately 4.3%, clearing Zone 1 on capital, but its final verdict is pending an audit. UOB sits on our Zone 2 watchlist with a durable ordinary yield of 4.06%. The difference between a sanctuary and a yield trap is decided before the opening bell, not after the damage is done. Investors who blindly chase the highest headline percentage find themselves caught out when structural adjustments conclude. The work has to happen before you commit capital, not after the announcement confirms what the forensic screen already showed. Iggy's elite investors had the full forensic breakdown before the market opened. Gearing ratios, occupancy gaps, debt overhang, and the VRD decomposition before the price moved. For 9 Singapore dollars a month, less than a coffee and kaya toast set at Raffles Place, you get 0-day reports and the complete red zone watchlist. Stop being the exit liquidity and start being the analyst. SingTel's VRD and the banking sector's capital returns share identical mechanics. Both provide a temporary short-term yield uplift, but both carry a clear expiry date. When they conclude, the underlying durable yield is left exposed and long-term portfolio income falls. For a retirement investor managing CPF and SRS drawdown, the distinction between durable yield and total yield is the difference between income that lasts and income that expires. Looking at the aggregate table, building a portfolio around a 5% headline yield when the durable income floor is closer to 3.5% creates an explicit financial deficit. For every 200,000 Singapore dollars deployed, that represents 3,000 Singapore dollars of annual income at risk. That is equivalent to 3 months of groceries and utilities for a Bidok household, completely wiped out when the capital recycling and buyback programs come to an end. With the Straits Times Index hovering near record highs at 5,015 points on 9 June 26, headline yields are compressing across the board. Companies are using structural adjustments and balance sheet engineering to keep their distributions looking attractive to retail investors. Chasing engineered yields without separating operational cash flows from capital distributions is a structural risk for retirement portfolios that rely on consistency. To finalize our positions, SingTel remains Zone 4 caution, with its core yield sitting at approximately 3.3% against our 4.7% hurdle. DBS is Zone 2 watchlist, calibrated to its 3.5% ordinary baseline. OCBC clears Zone 1 on capital strength with a 17.0% ratio, but its 4.3% ordinary yield requires a single stock audit before a complete verdict. UOB is Zone 2 watchlist, holding a stable 4.06% ordinary yield. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. If this analysis helped you see past the headline number, hit subscribe. The algorithm only recommends this channel when you do. This content is for educational and informational purposes only. Iggy is a retail investor sharing forensic analysis publicly, not a financial advisor. Nothing here constitutes a recommendation to buy, sell, or hold any security. Stocks assessed under Iggy's forensic yield standard are benchmarked against a 4.7% minimum yield hurdle. Growth watch stocks fall below this threshold but show clean balance sheets and identifiable growth catalysts, making them unsuitable as yield replacements for income-dependent investors. All investments carry risk, including potential loss of principal. Past performance is not indicative of future results. For decisions involving CPF, SRS, or personal capital, consult a mass licensed financial advisor before committing funds.